Okay, last category here is unearned revenue. Okay, unearned revenue is, again, has a special name, but it doesn't represent revenue. It represents liability. Okay, unearned revenue is a regular liability account. It increases on the right side. So just by its name, unearned revenue, that means the corporation haven't actually provided the goods, haven't actually provided the services, but they have the cash from client and customer on hand already. It's almost like the opposite of accrued revenues. Accrued revenues, the previous case was they have been providing e-learning services continuously. They haven't received the cash from customer. This is the opposite. Corporation could be signing a contract with client. Client readily pay the money in advance. So this, in the corporation's perspective, they have money on hand for the service that they need to provide later on. So they have the cash already, but they haven't provided the services and goods. So later on, when it reaches the end of the month, we want to represent the part of the service that we readily provided. Okay, so this is the opposite of accrued revenues. We collected cash up front now, but then later on, when we provide the services, we want to turn that liability into actual service revenue. But this account itself is a liability. So in the beginning of the year, let's say the beginning of May, I collected cash, the corporation collected cash in advance for 2 months of services. Then in the beginning of May, May 1st, you'll have an entry that looks like this. Debit cash, credit unearned revenue for, let's say, $1,000, for example. And this is, for example, worth for 2 months of work. And by the end of this month, when it reaches May 31st, I can represent service revenue for a month already, $500, and reduce the unearned revenue liability by crediting unearned revenue. Okay, so this is the part that we want to do, the adjustments part. We want to turn the liability into service revenue by a certain portion that company has readily, based on the service and goods that they have readily provided. So let's look at another example. Assume a law firm engages, again, Smart Touch to provide e-learning services, agreeing to pay $600 in advance monthly. So the cash will be received by e-learning Smart Touch company before they actually provide the e-learning service. Okay, so earlier, May 21st, you see this entry here, collecting cash, generating a liability account because they haven't actually provided the service, unearned service revenue. So remember, we record journal entries as it happens. Even though we haven't provided the service, since we have cash on today, we need to do something about this, record this in a journal entry. So in this case, it's not a regular service revenue yet, it's a liability. So what happens when it reaches the end of the month? So this $600 is for a month of work. When it reaches the end of the month, it's 10 days later, right? May 31st. So how should we adjust this entry? If it's 10 days later, then would it be $600 that we provided in terms of the value of the service? No, because 600 is for a month worth of service, right? If it's May 31st, it's only 10 days later, so we have 20 more days to go. So for 10 days worth of service, what would be the value for that? It would be $200, a third of 600, right? Assuming that all of these service revenue you can assume is on an equal rate every single day. Okay, so if it's 600 for a month, then you can assume that 10 days later it's only a third of it, which means it's $200. So we want to turn $200 of liability into actual service revenue because we have been continuously providing e-learning services. Okay, so the adjusting entry here is the second one. First one is the entry that happened in the middle of the period. The adjusting entry here is May 31st, the one we want to make before financial statements. Turn liability into actual service revenue for the part of the work that we have provided to client. Okay, so it's not entirely 600 because that's when it reaches June 21st. Then we fulfill the whole $600. Now it's only 200. We reduce unearned service revenue liability account by debiting this account and then turning the revenue into actual service revenue, just on the credit side. Remember, service revenue is an equity account, regularly, and increases on the credit side. Okay, so for T accounts here, you see that unearned service revenue, if I didn't tell you the whole situation above, if you just look at this T account, you should still be able to understand the information represented here. So if you look at an unearned service revenue account, remember this is a liability account. So once you see something under the right side, the credit side, that represents earlier you had altogether liability that worth $600. But now when it reaches May 31st, you reduce this liability by $200. So you still have $400 worth of liability, which represents the liability that is the service that you owe to clients, altogether worth $400. Okay, so later on when it reaches June 21st, when it reaches the month, then you'll be turning that $400, posting this to debit side and turning $400 into service revenue as well. You know, service revenue here, you have all the other entries that relate to service revenue, but this is particularly the one that refers to this unearned service revenue part. Questions so far? Okay, so again, what we're trying to do is making adjustments. These are not the major part of the journal entries. So all the major parts are regularly captured on a daily basis as transaction happens. The adjustments are related to usually some of the journal entries that we readily made before. We want to bring those accounts up to date. Okay, so earlier we journalized this entry. We didn't adjust it. It seems like we haven't provided any type of service to this client at all. So at the end of the month, we want to make adjustments representing that we have been working with clients to providing this type of service or goods. Okay, let's work on a problem here. Finis first gains a client who prepays $540 for a package of. Okay, so if this company collects $540 in advance and will be providing the training later, after 4 training sessions, what would be reported on income statement? So in the beginning, when the Finis first gains a client, prepays $540, then the entry would look like the entry that we covered earlier. We have cash collected, $540, and we have an unearned service generated because we owe to clients $540 worth of service. Right now, at the end of the month, the company actually provided 4 training sessions. So altogether, this $540 represents 6 training sessions altogether. So which means each training session would worth how much? $90. So $90 for each training session, and we have provided 4 training sessions already. So this will give us $360. So the next question will be, how do we journalize the adjusting entry? Okay, so earlier we have $540. This is a liability. And we're turning the $360, which we readily provided, the service that we readily provided, into actual service revenue. Okay, so on income statement, remember it only captures revenues and expenses. You will see, if this is the only entry, then you will see service revenue, under service revenue, a dollar amount, $360. That represents this 4 training sessions that company provided. Okay, so the beginning entry in the middle of the accounting process, it will be collecting cash, generating an earned service revenue liability account. Then later on, we turn that liability, a part of it, into actual service revenue. Any questions? Unearned service revenue, it's a liability account, so that will fall under a balance sheet. Okay, so yes, you will see the unearned service revenue. In the beginning, we have 540, and then later we reduce 360. So you still have about 100. Each training session worth 90. So you have 2 training sessions left. So you will see unearned service revenue under balance sheet, $180.